Buying and selling inventory is the backbone of your product-based business. But to be profitable, you'll need to understand your inventory's true cost. Hi, I'm Hector Garcia, certified public accountant, and I've partnered with QuickBooks to share tips on how to scale your growing business. Before we get started, make sure you like this video and subscribe to the QuickBooks channel for more videos just like this. This video series also has several accompanying articles that expand on this topic. Make sure to check the description below to learn more. When you're a growing product-based business like wholesale, manufacturing, or e-commerce, you need to have a solid grasp of your inventory's true cost. As your business grows, so does the complexity of managing inventory. In a product-based business, inventory can make or break your profitability. Too little inventory runs the risk of not having enough to meet sales demand, leaving money on the table. Too much unsellable inventory runs the risk of inventory obsolescence, not to mention all the indirect costs of having excess inventory. Let's explore two concepts. One is called carrying costs, which mostly represents indirect inventory-related expenses, and the other is called landed costs, and that represents direct inventory-related expenses. With carrying costs, we typically take a look at the cost of financing, such as interest paid on loans or lines of credit used to fund your inventory purchases. It's not a surprise that inventory tends to be one of the most capital-intensive investments for a business. We also take a look at overhead expenses indirectly related to inventory, like the cost of maintaining a warehouse, racks, safety expenditures, warehouse supplies, and so on. Finally, there's the facilities cost. This is the cost to rent a warehouse and to pay for any associated utilities. This is especially important to consider when it comes to inventory that requires refrigeration or any sort of climate control, as it will draw more electricity costs to your business. Essentially, all the expenses that wouldn't exist if your business didn't carry inventory are considered to be carrying costs. The problem with carrying costs is that even though they're easy to identify in the macro level, it's really hard to attribute these costs to individual inventory items. Even if you could do it, it would be impractical to spend the time and resources to work out the calculations. Carrying costs are numbers you need to pay attention to while managing your business, but they are not necessarily calculated into the inventory valuation for the purposes of measuring profit margins. This brings us back to landed costs. These are expenses directly linked to your inventory, such as shipping and transportation, insurance, customs, and transaction fees. Basically, it's anything that can be linked to every shipment of inventory coming into your stock. Some businesses tend to ignore the significance of these costs and just account for them as period expenses. But growing businesses prefer to allocate those direct expenses into each of the items being received because they are more directly linked to individual transactions. With landed costs, your inventory valuation will be increased to include this cost. This gives your team an understanding of your margins and a much more accurate picture of how much your inventory actually costs. And this knowledge can inform how you think about pricing strategy. For more information about this, check out this other video on pricing strategies. You should also pay close attention to the rising inventory costs due to inflation and supply chain unpredictability. It's important to understand the difference between FIFO valuation, or first in, first out, and average costs, so you can choose the correct valuation method for your business. FIFO allows you to track your inventory value based on how much the products cost when you purchase them. As the older inventory is sold first, those costs are differentiated from the newer purchases. So if you have increasing costs, your less expensive ones will be sold first. With LIFO, last in, first out, if you have increasing inventory costs, your most recent or expensive inventory will be sold first. But FIFO is more commonly used, as it tends to give you a more chronologically accurate representation of your inventory value. In contrast with FIFO and LIFO, the average cost method tracks all inventory, old and new, with the average of all current inventory purchases. Getting back to the importance of landed costs, one of the features I love about QuickBooks Desktop Enterprise is the landed cost module. It allows you to easily categorize a particular bill or expense that contains a landed cost component, and with just a few clicks, reallocate the cost based on quantity, percentages, or a fixed amount at the item level. With QuickBooks Desktop Enterprise, you have the flexibility to track your inventory in FIFO and the power to utilize the most accurate inventory evaluation reports in the industry. Learn more about how QuickBooks can help you manage your landed costs by checking out the link in the description below. Was this video helpful? Share it with someone in your network and let me know what you think by hitting that like button. See you next time.